Right then, good morning, everyone. Thank you very much indeed for joining us. My name is Darren. I'm one of the international sales managers here at Novia Global. Pleasure to have you all with us. Just checked the numbers this morning, and we are live, obviously, and there's a fair few of you logged in. So great to have your company. And I've got to start by saying that from speaking with advisors over the last few months, we really do get a good feedback on these Pulse webinars and also Pulse newsletters that we send out. So thanks for that. It's good to know it's appreciated. Ultimately, the aim with them is just to assist you in the conversations that you have with your clients. And some of the stories that I've had vary from printing out the newsletters, next time there's a quiet moment with a cup of coffee to read through them. We do share the videos. They'll be a link to them will be emailed out to you afterwards. And I hear of advisors taking showing those to clients during meetings with clients, perhaps sharing the link or showing it on a tablet during a face-to-face meeting, which is good to hear. And we do get lots of requests for snippets of graphs and charts and things that are displayed during the webinars. So please do keep positive feedback coming, and it's great to know that it's of use to you. And I suppose on that note, it's a very pertinent topic today regarding inflation. Obviously very much in the headlines at the moment. And again, from having conversations with advisors, what a lot of advisors have said to me is that certainly during COVID, that actually a lot of their clients were relatively comfortable with the markets crashing and perhaps saw markets dipping as an opportunity to invest, and that perhaps the 2008 financial crisis was still very much fresh in clients' minds at that point, and so the markets dropping didn't bring so much fear. However, sort of the inflation at the moment and the situation in Ukraine does seem to have generated some anxiety and trepidation amongst clients. That's certainly what I've heard anyway. So we've got Nathan and Sheldon from the Marlborough Group with us, and they're going to take you through some pointers on this topic. Had the pleasure of listening to them both a couple of times before, so I'm sure it'll be a good one. So just a little bit about the Marlborough Group. I don't want to tread on anything Nathan and Sheldon are going to say, but again, speaking with advisors, get lots of comments regarding the special sits funds. That's a very popular one in portfolios, in client portfolios. But I think what's often overlooked is that there's sort of almost 30 years experience of multi-asset investing within the Marlborough Group, and so I'm sure Nathan and Sheldon will touch on that more, and also there is an exclusive discounted N share class of their multi-asset range available via Novia Global, which again we can touch on a little bit later. So as I said, we are live, so if you do have any questions, anything that occurs to you during the course of the webinar, please do send those in, and we can put Nathan and Sheldon on the spot with some of those questions at the end there. So that's enough from me. I'll pass over now, and I'll pick up with you all at the end.
Thank you, Darren. Hello, everybody, and thanks for joining the call today. So today we're going to cover several topics, including inflation and the cost of living crisis. What does a recession mean for markets? And what's next for investors in 2022? So let's start off with this slide here. So if we start with inflation and the cost of living crisis, investors have had a huge amount to contend with this year. So one of the most prominent concerns has obviously been the cost of living, aka inflation, or costs rising. And what we've seen is inflation reaching levels not seen for over 4 decades. So some sizable moves within inflation this year. So this is causing one of the biggest cost of living crises most of us will have seen or will ever see in our lifetimes. So in response, as we all know, central banks have been raising interest rates. So the whole logic here is that by raising interest rates, they're trying to discourage spending. So essentially, if your mortgage rate goes up, you're spending less money. And if people are spending less money, this reduces prices as consumer demand falls. So that's the end goal of central banks. And if we look at the US specifically, it's been very encouraging to see inflation falling from its peak in June. So we had a reading of 9.1% in June, and the latest reading in July was 8.5%. So the critical question is, and I'm sure you're all asking, are we past peak inflation? And it depends on the region, and I'll come to talk about Europe later in the slide deck. But if we look at the US specifically, we believe the answer is yes, and we believe it's yes for the following reasons. So if you look at a variety of different commodities, those commodities have been falling in price since they reached a peak in February this year, which obviously coincides with the invasion of Ukraine by Russia. And we know that commodity prices and commodities rising has been one of the key inputs into inflation. So the fact that commodities are falling is quite a positive. The other thing to note is that if we look at retailers or shops, they've got high inventory levels. Because you're now seeing lower demand, it means that these shops are going to discount a lot of that inventory, or basically cut prices and put goods on sale. And that means that people will be able to pick up things at cheaper prices, which feeds through into lower inflation. Now, clearly, higher interest rates is obviously having a big impact on the housing market, particularly mortgage rates. So as mortgage rates rise, this cools demand for housing, which cools demand for a lot of various different types of spending. So if you think about the first time you bought a house, if you bought a house, you obviously had to furnish that house, and there's a lot of spending that comes with buying a house. So if there's less houses being sold, then that also takes a lot of spending out of the system, which helps to bring down prices and thus inflation. And then lastly, you're seeing a lot of consumers changing their habits, so spending habits. So whether that's cutting subscriptions they have or shopping at shops where products are cheaper, but all of these little changes help to reduce inflation. And this is the key thing that the central bank is trying to achieve by raising interest rates. But let's focus on this chart here. So what this chart shows you is the Federal Reserve's favorite indicator for inflation. So it's called the PCE, or Personal Consumption Expenditure Price Index. So essentially, it's just a metric for assessing prices of goods going up in the economy. And of course, you know, the Fed is looking to obviously rein in inflation by raising interest rates. And the good news is you've seen the first monthly decline in this measure since the early days of the pandemic. You know, so what this is doing is providing you evidence that the Fed is achieving its goal, or beginning to achieve its goal. So when you put this alongside the fact that commodity prices are falling, so specifically talking about petrol prices here and oil prices here, it's showing you that central banks are beginning to win the fight against inflation. However, we all know that central banks are not declaring victory yet and are still looking to raise interest rates to bring inflation down further. Now, one of the other things which markets were keenly focused on over the course of this year was supply chain disruption. And I know all of us have experienced this to some extent, some obviously a lot more than others. But this chart here shows you the supply chain index. So it's just measuring how supply chains are managing in this current environment. And obviously you can see that supply chains have been easing. So things have been moving more freely. But what we do know is that supply chains were disrupted, and this impacted everything from petrol to microchip shortages. And all of these little things contributed to higher prices or inflation. So the fact that we've seen supply chain disruption reaching peak levels during the pandemic, and the fact that they're now starting to roll over is quite a positive sign, which will also feed through into lower inflation. And this is as a result of activity ramping up in rail, airline, freight, and trucks, as well as essentially supply chains normalize and start to operate a bit more efficiently. And you're probably seeing that at airports as well. You saw a lot of congestion during the summer months, but obviously airports have hired a lot of people to deal with this, and that's happening across the spectrum. So this is, you know, kind of evidence that inflation is falling, and markets like to see this. So this is one of the things that has been holding markets back this year, basically inflation. However, the point is that winter is coming, and it is going to be a difficult difficult period for many. And I kind of mentioned at the start of the conversation that inflation will be different in different regions, and Europe is likely to fare the worst. So you obviously have the ongoing war in Ukraine, and that's led to a lot of risks for Europe, particularly the shutdown of gas supplies which have led to a spike in natural gas prices over the last month. And this increases the risk of recession for Europe later in this year. But what we're starting to see now is that governments are starting to look at putting in support packages to help cushion the blow of the higher cost of utility bills. Now, we're expecting to see something being released in the UK probably tomorrow around this. And the idea here is that this will help to reduce inflation. So basically, if you can put a cap on the cost of energy bills, which the man and woman on the street is seeing, then this will help to lower inflation. And actually, I was just reading in the FT last night that EU energy ministers are looking to meet this Friday. And so they'll be looking at two different things to implement. So it'll either be A, looking to help people pay their bills, or secondly, helping energy companies manage their costs as well to help bring down the cost of those bills. So what we expect to see over the coming months is a lot more support coming out. And essentially, if you get those caps coming in place, that puts a lid on inflation. So the expectations for those really high prints of inflation in Europe are likely not to materialize if you get a positive outcome from those meetings. So we'll be watching that closely this Friday. So what I'm going to do now is I'm going to actually hand over to Sheldon, and Sheldon is going to cover the next section on what does a recession mean for markets.
Thanks, Nathan, and good morning, everybody, from me. Well, firstly, though, before we speak about what it means for markets, just let's think about, are we in a recession at all? So there's a bit of confusion around this because for the last couple of years, we've all been told that 2 consecutive quarters of negative growth equals a recession. And we've seen that in the US. We saw Q1 minus 1.6% growth, Q2 minus 0.6%. But yet we've been told that actually, no, it's not a recession. So what's going on there? Well, that 2 quarters of negative growth is really kind of a shorthand indicator. Officially, though, a recession only occurs when something called the National Bureau of Economic Research declares that there's a recession. And they're looking at a multitude of things, not just the economic growth, but they're looking at things like, more general, broader indications. So they're going to look at job numbers, consumer spending, production levels across industries. Really just making the point that looking at growth in isolation doesn't really give you the full picture. And so they look at other metrics. And what they're saying at the moment is that actually, negative growth aside, the economy is actually not doing too badly. We've got, in particular, pretty good wage growth. So the man in the street that Nathan spoke about earlier is doing okay. Yes, there's high inflation, but he's earning a lot more than he was before. And so he can kind of afford the higher prices. Now that itself, though, is something that the central banks are looking at. We, as Nathan's indicated earlier, we started to see in the US some of the indicators for inflation starting to roll over. Markets got quite excited about that because they thought, well, actually, maybe the interest rate hikes that we've priced in might not need to be quite as bad as we'd feared. And so markets started to rise. We had a lovely summer rally, but the Fed really poured cold water on that. We had a symphony of hawkishness from central bankers around the world who'd gathered at Jackson Hole for their annual symposium, and really just reflecting the fact that we need to make sure that inflation is dead before we ease up on the interest rate side. The Fed in particular will be looking at the history of what happened in the 70s. In 1975, 76, they had an opportunity to really kill inflation. They didn't. They eased rates a bit too soon. And it then, inflation stayed high for another 5 years. And it took a pretty deep recession to cure that. And that was only in 1980, 81 that they finally managed to do that. So they're going to be looking back at that and saying, now is not the time to start cutting rates. They need to talk tough. They need to make sure that markets and economic participants, so companies and so on, all really get the picture and moderate their patterns of spending and so on, that they get the message that wage rises can't continue at this level, that we can't keep on validating these higher prices. We need to break that link. And so they are talking tough. They need us to they need the economy to break that the potential spiral of higher inflation expectations, which leads to higher inflation, which leads to higher inflation expectations. So they need to break that, and so they really are talking tough. What that might mean then is that we do get higher rates than the most recent indications were. People started to believe that maybe rates wouldn't be as bad. They probably will be worse than maybe we'd start to price in, and that means there is more likelihood of a recession ahead. Now, we're showing here the US. The US is in general first in, first out. They're further along the cycle than other regions, and obviously it's the major economy in the world. So the US recession is looking like being actually fairly shallow, fairly limited, and so not that big of a deal. Europe will probably suffer a deeper recession than we're seeing in the US. Now, I mentioned the jobs market, and this really is something that Jerome Powell, the Fed chairman, has been hot on. He's been repeatedly in the news saying we need to make sure that the job market cools. And the reason it's not cooling is that there are just so many more openings for jobs than there are unemployed people. And so people are competing for these jobs, pushing up the prices. One slight bit of good news that we saw in the latest jobs number was that we are getting more entrants into the market. So unemployment is a measure of the people who don't have work, of those who are looking for work. Now, in the pandemic, a lot of people simply removed themselves. They weren't working, but they weren't actually looking to work, and so they weren't counted as unemployed. What we're getting is people returning to the jobs, to the workforce, and will be able to fill in these unfilled vacancies. And so perhaps that'll indicate going ahead, a slight easing of the inflation pressure that we're getting from the jobs market. So that's really one of the encouraging factors. That's all at the economic level, though, what we've been speaking about. What we need now to think about, though, is what it means for markets, because, as you know, markets discount things ahead of time. So have companies been able to weather the storm in this difficult economic environment, in this lower growth environment? Have companies been able to deliver positive earnings? Because that's really what you're buying when you buy a share. You're buying, a share in those future earnings of a company. Well, so far it looks like companies are actually delivering pretty good earnings growth. That look at the blue bar here. In Q2, earnings were up 6.7% for the calendar year so far. They're up 9% on the previous year. That looks pretty good. Thing is, though, if you look through the details, and if you X out energy companies, actually it's not such a great picture. And that's the green bar here. So for the year to date, yes, still positive, 2.4, but the latest reading, Q2, was actually down on the previous quarter. So some companies are starting to feel the pinch. As I say, once you X out energy and look at the remaining companies in the economy, starting to see a little bit of an indication of weakening in earnings. And that again is coming through in the share prices that we've seen. So it's hard to tell, obviously, and you'll never know precisely exactly what's been discounted by markets. But the latest move down that we've seen after the summer rally would indicate that investors are starting to price in these slightly less rosy earnings pictures. So these are operating margins, and this obviously is what leads to earnings. Operating margins are under pressure. They've been falling, as we can see on the right-hand side of the chart. They have come off their peaks, and that's a positive. The recent spike, though, in unit labor costs that we've been seeing, that would indicate that there might potentially be a little bit more downside to see here. Having said that, though, they are still pretty elevated relative to history. So we've got, what have we got here? About 15, 16 years worth of history here. And you can see even after the fall that we've seen, we're still pretty close to the certainly top quartile of the graph. So even if there's a further decline, company profitability, especially in the US, still looks pretty promising. The point, though, that we all need to make is that markets have probably already discounted all of this. We know that markets and investors are looking probably something like 6 months ahead. And we've seen in previous cycles that markets bottom, prices, share prices, reach their troughs well before, probably about 4 months before on average, before corporate earnings actually bottom. So markets do anticipate the turnaround, and that's really a positive for us. We do think we're over the worst. We do think markets have anticipated and priced in a lot of the weaker economic outcomes that we're going to see, and could potentially turn in anticipation of a future rebound. So I'll leave it there and pass back to Nathan to take the next section.
Okay, thank you, Sheldon. So what's next for investors in 2022? So this is a great slide here. So this was actually one of the catalysts for the rally that we saw during the summer. So basically, this chart is showing you risk exposures for fund managers has been at the lowest level since Lehman Brothers. So basically, we have a survey which is compiled by the Bank of America. And what they do is they survey 293 different fund managers. And those fund managers represent about 722 billion of assets under management. So they ask those managers various different questions. How are you positioned? What's your cash level? Are you risk on? Are you risk off? So after surveying those managers, they realized that actually everybody is extremely bearish, and as bearish as they were back in October 2008. So the question is, are we in a similar period to 2008? The answer is obviously no. We had a financial crisis then. We have a healthy banking system now. So the key point is that people are very fearful, and they have lots of reasons to be fearful. So you've got war, supply chain disruption, you've got inflation, you've got interest rates rising, bear markets, falling profits, risks of recession, some countries actually in recession. So who in their right mind would think it is a good time to invest? And the answer to that is obviously very few people, as you can see from this particular slide, because the evidence here is that fund managers are avoiding risk, they're hoarding cash, they're avoiding equities. However, we all know intuitively that smart investors will be allocating to markets exactly at this time. Because the way to think about it is, if you went into a car sales lot and they said, actually, it's 30% off all cars. Is that a good or a bad time to buy a car? It's obviously a good time to buy the car, not when the car is trading at full price. So it is, it's obviously very difficult to do that as an investor, but you have to be aware of your behavioral bias. We all know that it does pay to be greedy when others are fearful. So on the next slide, this is just a measure that, it was an interesting slide, I thought. So it's just a measure of looking at where do equities go. So what you have here is you have the US 10-year, which is basically just the 10-year bonds within the US, and the yield on that bond, or the income that they pay for owning that bond, and it's showing you then the S&P 500. So the point here is that as the costs go up, as in financing costs, as in bonds going up, as the central bank is raising interest rates, the equity markets have been falling. So there's a correlation between those two. So when one is going up, the other is going down. So we think this is an important metric to look at, because what we're seeing now is we're seeing that inflation has peaked in the US. We're expecting to see a lot of packages coming in to support gas and utilities and people in Europe and the UK. which will put caps on energy and utility bills, which has been one of the biggest inputs into inflation. So as they come into force, that means that we see peak inflation in Europe sooner than people anticipate. So people are expecting that we're going to get this peak inflation sometime next year. But actually, if all those energy ministers sit down and they come up with a good conclusion at that meeting, it means that we could see peak inflation in the next month. So once you start to see that, then central banks will start to question whether or not they need to continue to raise interest rates. So if interest rates come down, then this 10-year bond will start to come down and equities will start to go up. So that's what we're looking at. We want to see central banks basically halting their rate rises. And as Sheldon mentioned, the market is looking at 6 months out. And, if that inflation data comes out, then that'll happen sooner. And therefore, markets will begin to price that in, as in equities will start to go up. So on the next slide, this is talking about the shape of the recovery. So we all know that over the last couple of years, anytime the market fell, the mantra was buy the dips. And that's because basically the market tended to basically react quite quickly to the upside. And you had these very sharp reversals. Now, obviously, clearly this time is different, and that's for a number of factors, because obviously we have inflation. So we think that the shape of the recovery will be U-shaped, not the V-shape that we're used to, particularly over the last decade. So we want to keep in mind that markets are going to continue to remain volatile in the months ahead, particularly as economic growth continues to soften and central banks raise rates. So from our perspective, we are fully invested, but we do favor a defensive positioning. So that's both for our equity positioning and our fixed income positioning. So, within the equity positioning, we have a tilt towards income. So we think that those defensive companies tend to perform better in market uncertainty. And even within fixed income, we have very little risk. So the bulk of our exposure is to government bonds and investment grade, so high quality. And obviously having that exposure to short duration has also been beneficial. But the other thing we're doing is, talking back to, the opportunity, is that we're building out a shopping list. Because ultimately you've got all of these assets, they're all on a big discount. So the time to do the work on what you want to hold is now. So we're looking at some of the things that are very oversold and thinking, okay, when things start to change, what do we want to buy and how much do we want to hold? So we're doing a lot of work on that, because we do know that at some point, and it's probably going to be by the end of this year, central banks will pause their rate hikes because inflation should start to moderate, particularly as you get those price caps in areas like Europe, and we're already seeing that in the US. And that then provides a backdrop for a lot of these assets to rebound. So we all know that the first half has been quite challenging for investors, as in the first half of this year, but a lot of the data is starting to suggest that the markets are stabilizing. So we don't think the markets are going to move in straight lines, but we do think that the worst is behind us, and broadly we should see a better outcome in the second half of this year, and we're already seeing that to some extent. Now, if I was to leave you with anything, it'll be this slide here, because obviously we can all get very focused on the short term, particularly when markets are volatile and particularly when there's lots of bad news out there. So it's very easy to get caught up in all the hysteria, and I'm sure a lot of your clients are probably concerned about markets because of everything they're reading. But we all know that there's exactly the wrong time to react. So just to give you a little bit of a snippet, if we think about bear markets, so this is when your markets are falling 20%. On average, bear markets basically fall about 34%. So this is a bear market when you get a recession, and they last for about 13 months in total. And so that's at the time when you have the peak negative news flow. That's when your client is most likely to react, is most likely to sell. And as we all know, that is the worst thing to do, because bear markets are followed by bull markets. And the best opportunity is obviously after you've had those significant falls. And the good news is obviously bear markets last for a lot longer on average. So 4 years on average, but it's actually the return that I'm more concerned about. So on average in a bull market, you get a return of 167%. So it really kind of solidifies the point about not trying to time the market, remaining invested in the market and actually using episodes like this to take advantage of the opportunities. So we do see that kind of U-shaped recovery, but from our perspective, we are firmly looking at what we should be holding on the other side of this. So that's all I was going to cover at this point. So we're definitely happy to take any questions anybody has and cover off anything you'd like to raise.
Great stuff. Thanks, gents. That was really interesting. Couple of things I noted down actually from listening is firstly that was a great chart there regarding risk exposure being at its lowest levels since Lehman Brothers collapse, and also just obviously lots of negativity about the moment. Just trying to look for some positives, and the central banks slowly starting to win the fight against inflation. It was good to hear, and then also just some interesting stuff in terms of the job market as well. The fact of the lack of a recession in the jobs market would obviously should be viewed as a good thing, but perhaps counterintuitively, it because of the spike in unit labour costs, it's perhaps not what's needed right now. Is that fair to say?
Yeah, I think so. I mean, it's like everything. There's a positive and a negative to take from everything. I'll come on in a second to the measures that governments are going to provide on energy bills. So I mean, there's always a trade-off. So yes, you get things that may help from an economic perspective, but they might not necessarily help from a market and a share price perspective. So the higher wages, that's great. It's good for the consumer. They can spend more, and that should help companies be able to increase their margins and so on. On the other hand, the companies are also having to pay those higher costs, so they're getting that eats away at their margins. So different companies will have a different kind of reaction function to that. Some companies will get the benefit of that. Some companies will be on the wrong side of that equation. So hard to tell. The point though is that for the moment, earnings estimates by analysts are not being brought down dramatically. So the question is there another shoe to drop? Are we going to get an earnings recession at some point? Now, that negative number that I showed you from Q2, once you X out energy, is concerning. It's not alarming. It wasn't big enough to really give the market that much pause for thought. On the other hand, if we do see it turn further negative and you get a big drop down, that might then be perceived as more negative. But the point is though that we don't know. There's this uncertainty in the market, and hence the U-shaped recovery, we may sort of trundle along at current levels in volatile fashion for some time yet, and that's behind the positioning that we've put into the portfolios. So we're maintaining our weight in equities, so we're neutral overall from a weight perspective, but the exposures that we're putting in place are these ones that are slightly more defensive in nature. So looking for those companies that the kind of company that can deliver a nice, stable, steady, potentially growing dividend stream in a difficult environment is the kind of company that will be rewarded in its share price, the kind of company that people will start to seek out. And we think for this period of volatility, we think that's the right place to be. I did say I'd come on to the energy measures, and of course, for us as consumers, it's great news that energy bills are going to be capped. It looks like we're going to get something in the UK. Germany has already announced a package. Around Europe, there's going to be other packages. The thing is, though, there's no free lunch. So what we're trading off here is potentially inflation now for probably higher taxes at some point later. Yes, Liz Truss will want to cut taxes, but eventually you have to pay the piper, right? So all these packages, an energy package for us consumers to ease the burden on us and on companies, eventually you've got to pay that bill. And the government has to raise funds at some point to pay that bill. Maybe now is not the time when you're staring staring down the barrel of a recession potentially. But at some point that bill has to be paid. So there's a short term versus a longer term perspective on these. Markets do tend to look through things. On the other hand, they probably will take the positives first at the moment, just given the mood of the market, the sentiment, the fact that consumers might have the burden on consumers might be eased. I think market participants will probably take that as a positive and kick the can down the road in terms of when do we pay for this. So for the moment, we think that's a positive for markets.
Great, thank you for that. That's much appreciated. And we have had some questions, so I'll start with those if that's okay. First out, the traps was Stephen. I think probably answered this maybe on a sort of micro level, but on a more macro level. Stephen's asked, what assets and sectors do you prefer to reposition to?
Yeah, so I think if from an asset allocation perspective, one of the asset classes or regions we liked coming into this year was UK equities. And the reason is that generally when you get a downturn in markets, the UK market tends to outperform other markets. And that's just because the UK market tends to have more defensive sectors within its benchmark or within its index. So you've got tobacco companies in there, you've got utility companies in there, you've got drinks companies in there, and obviously you've had a huge benefit from the gas and oil companies within the benchmark. Just very recently, we've actually reduced that overweight to a neutral. And the reason we've done that is because we do see the potential for inflation to peak. And there's also the risk of recession, which means that some of those sectors which have done well, like oil and gas, will fare less well. So that is an area that we've been reducing. But other areas we like are things like commodities. So I see there is another question around our exposure to physical commodities. And if we look at the portfolios as a whole, we have between, say, 2 and 4% exposure to gold. So that's physical gold. Now, gold is used as a hedge against inflation. However, it hasn't performed as well as you would expect in an inflationary environment because it's also denominated in dollar and the dollar has been strengthening. And ultimately, a lot of people around the globe do buy gold. But if it becomes more expensive because the dollar is strengthening, there's less demand for it. So therefore, that hedge hasn't worked out in the way that you would expect it to. So, just an air of caution around the other things which can impact that exposure. However, if you do see rates coming down and there is concern about recession, then you may see actually some of these commodities performing a little bit better because the currency side will weaken.
Another area that we've pushed into a little bit, not in a huge way, but infrastructure. We think that's an area of diversification, number one, and also an area that can potentially do well in a higher inflationary environment. If you think of the kinds of investments that infrastructure funds go into, toll roads, bridges, ports, and so on, all of these revenues are inflation indexed in many cases. And so as inflation rises, they're earning higher revenues. So introducing that into some of the portfolios, just to, as I say, give some diversification and also that inflation protection.
Brilliant, thank you. That's a really good detailed answer. Thanks for that. Some of the questions coming through, I think perhaps a bit have been covered already in your answers, which is great. So there's a couple of questions from Tom, so I'll read those to you. If central banks do pause interest rate rises towards the end of the year, and going back to your slide on the correlation between 10-year Treasury yield and equity markets, has this historically always been correlated? And then just following on from that, will bond prices correct as equities start to rise?
Yeah, so if we think of, I'll take the second piece first. So if we think about bonds, they've obviously sold off this year. And normally what we expect to happen is if equities fall, bonds are a hedge. They tend to outperform. But the difference this year is that the reason bonds are selling off is because central banks have been raising interest rates. And they tend to sell off if central banks are raising interest rates aggressively, which has happened this year. And that's why you've seen bond prices coming off this year. But what you'd expect to happen is if central banks then start to reduce interest rates, you'll see some good pricing coming through, and you'll see some of these areas doing well. So some of the fixed income areas performing quite well, and equity. So what happened last month is you had a risk on month for both equities and bonds. So we'd expect to see some positive returns coming from both sides of those asset classes, should interest rates start to come down. And then that correlation between the 10-year and equities, now it does vary slightly depending on lots of other factors, but there is that correlation there between the two.
Yeah, there's a technical aspect of the correlation as well. This may get a bit geeky, but if you think about the valuations of companies, what you're buying is a share of those future earnings, as I indicated earlier, right? So you've got these future earnings that a company is going to deliver. You need to discount those at an interest rate to get to the present value to determine the price that you're willing to pay for the company. So if you're discounting those at a high interest rate, you get a low present value. If you discount those at a lower interest rate, you get a higher present value. So lower rates technically translate into higher valuations, all else being equal. The thing is, though, all else is never equal. There's always so much else going on. There's a lot to do with sentiment, with the mood of markets, and as I indicated earlier, the growth, the changing growth patterns of the expectations of the future earnings that may grow. So there's a lot going on, but there is an argument to be made that you probably will see this correlation between the two. If you think about the period in which bond markets could start to do well, that's in the period when bond markets start to anticipate this reduction in interest rates. And that's only going to happen once you're through the worst of the recession, right? When central banks need to start cutting cutting in interest rates in order to re-stimulate the economy. Now, at that point, so bonds are doing well at this point, but also equities then start to anticipate this reflation trade. So there is, as I say, the potential for the correlation to continue. It's never a perfect correlation, of course, and so the diversification benefits that you get from having bonds and equities are still positive. And of course, at the moment, different to what we've had in the last decade, is you actually do get a decent yield by holding bonds. For the last decade, we had the articles coming out around the death of the 60-40 portfolio. We've probably spoken to you before around TINA, there is no alternative. When there was no other alternative other than holding equities, because you didn't want to hold bonds because they were at such low yields. The only way was up in terms of yields, bond prices being the inverse of that. You didn't want to hold cash because even if inflation was low, you're still giving away cash, giving it away to inflation. You didn't want to hold property because of the liquidity issues, and so really the only alternative was equities. But now, in bonds, you can get a decent yield. Income-hungry investors can use bonds to provide some of that income. You can get income from equities. And so we're back to a situation where a balanced portfolio makes a lot more sense than perhaps it did at any time in the last decade.
Great, thank you. I'll just do one final question then, if that's okay. But this one's from an anonymous attendee, but is inflation high everywhere?
No, and it's different in different places. Different people, people are all different, but different participants are feeling inflation in different ways, and it depends on the basket of goods and services that you're consuming.
Yes, it's particularly low in Asia. And so think of a lot of the goods that we consume come from Asia, and a lot of the costs which we felt this year is due to supply chain disruption. So obviously, if you're in China, it's easier to get the goods around China and in that region, and it's much more costly to transport those goods across the world, particularly when you had the cost of cargo ships going up and renting those cargo containers. So inflation is quite low in Japan. It's quite low in China. It's obviously starting to roll in the US, and it's still going up in the UK and Europe. We do expect it to peak in Europe and the UK pretty soon.
Great, thank you. So yeah, I mean, we have had a question actually on performance. I mean, what I will say is if you do want to know more, there's the details of Linda and Rod there you can speak with. Also at Novia Global, we do work very closely with the Marlborough Group, so your international sales manager will be able to answer any questions you might have regarding the exclusive share class that's available. And also, Marlborough do provide us with some performance stats, and it shows that, as I think you'd be able to vouch, chaps, that it's certainly the multi-asset range against some of the sort of household names, if you like, the performance stacks up really well compared to peers.
Yeah, definitely. I think for us, one of the standout things this year has been our focus on downside protection. So ultimately, when we're screening for new investments, that's one of the key things that we look for. So how do funds perform when things get tough? So we want to see that funds can actually do well or hold up well in those down markets. So if that's one of the disciplines we apply within our research process, it means that the portfolios in general would tend to hold up well, and that's been the case. And therefore, we're pretty happy with the performance we've delivered for clients this year.
Great stuff. Thank you. Okay, I think we'll leave it there then. So all that remains is me to thank Nathan and Sheldon very much indeed. That was brilliant, really interesting, really engaging, as I knew it would be. So thank you both. And as I say, if you need anything at all, do get it. There's contact details there for Marlborough, but also you need to feel free to give your international sales manager a shout. So our next webinar is on the 27th of September, so we'll send some details out regarding that in due course. So yeah, thanks again for logging on and listening, and thank you, Nathan. Thank you, Sheldon, and yeah, we'll see you all again soon.
Thank you.
Thanks very much. Cheers.
Bye bye.